2020, I took the time to record a special podcast specifically related to COVID-19, the stock market, the economy, and what we were doing to help evolve client portfolios. It was, it was and continues to be a very trying time economically, which I thought it was a terrific opportunity to take a minute, breathe, pause, and then share how we were taking clients through this really difficult time and the type of portfolio positioning items that you needed to think about, how you might want to evolve your own portfolio, and other questions that you might have. Maybe this podcast can answer. If we didn't, certainly don't hesitate to reach out to us at any time. You can follow us at Manage the Funds. That's our social media handle. Or you can always find us on the web at managethefunds.com. I hope you enjoy the podcast. Take care and have a terrific day. Enjoy. Hi, everyone. This is Michael Carlin, president of Henry+Horne Wealth Management. And I wanted to make sure that I set aside a bunch of time the way that I normally would when, I typically sit down with clients and go through the State of the Union, where we are now, where your portfolio is, and essentially what we are looking to do to navigate this situation going forward. So this is for those of you that have been clients of mine for a long time, this is going to feel very similar to what a regular meeting is, I hope, other than the fact that I'm wearing a more comfortable t-shirt and I'm working from home. So excuse the casualness, but this has been a very unusual time. I know that many of you are aware of what's going on right now with the market. We have gotten more calls and emails than ever before, certainly even inclusive of 2008. We understand that there's a sense of unrest with this situation that is concerning and atypical, and the market is capturing that expression very well in its most recent performance. So what I want to do is I've gone through and I've spent a number of days aggregating slides and data the way that I normally would to put context around what's going on right now. And I'm going to kind of weave in through that exactly what we are doing to and inside the portfolios. Many of you see some of those changes that we've made today. And I'll explain context as to why we're doing it and some things that hopefully will make sense moving forward. So with that, I'm gonna be looking at one screen which has some data on it. Occasionally I'll look to share it. So I'll be going back and forth and trying to make good eye contact with the camera as well. So the volatility in this particular stock market has been something that has never been seen before. And today, on Monday, we saw yet another day of historically massive performance and volatility. The volatility is so great, in fact, that it is more volatile price-wise than it was even during the financial crisis. We haven't seen this kind of volatility ever. The last traders to have seen it would be those that were working during the Great Depression. And the amount of volatility we're seeing right now is even greater than what was seen during the Great Depression. That should provide a sobering moment for everyone listening, and that is the amount of concern that you're feeling is accurately being reflected in the uncertainty in the stock market. And the question is, and I'm going to go ahead and do a screen share to mix it up a little bit. So why don't we go ahead and do that? Okay, great. So in the span of 3 trading days, from March 12th through March 16th, you can see the S&P 500 had its 7th worst day on record. And on the 12th, its 10th best day on record on the 13th, and its 3rd worst day on March of the 16th. Massive volatility. But look at this from a historical standpoint. Look at here, where you're seeing, the daily downside and the daily upside. Have you seen these kind of numbers? Yes, this is the day the market went down 22% in 1987. By the way, that coincides to the day that I first started buying stocks. And if you look back historically, we didn't see these kind of down days even back in the Depression. And you would assume that these good days would normally happen at a time where, you know, oh boy, I think that really, okay, I think that I'm now sharing the screen. Okay, great. Well, you see the up days here, and the down days here. We haven't seen down days like this again, really since that 1987 correction. It's been an incredibly bizarre time. So big picture, the volatility is massive. The volatility is real. It is expansive. So let's talk about the reason why. It certainly has everything to do with the COVID-19 virus and the shutdowns that we're experiencing right now. We haven't seen this kind of shutdown ever, and we don't know what to expect for the economic shock that we're going to be feeling the full brunt of in the second quarter of 2020. Remember, the first quarter of 2020, January was normal, February was normal too. Remember, the market was up most of the month of February. It's really in this month that we're seeing this massive sell-off, and then what is April and May going to look like? And we'll talk about some of those expectations, but we first need to share a little bit about what we think that the virus is up to. So let's go ahead and take a look at the latest data. Now the share is working great. So if you look, many people look at the Chinese data with some skepticism, but if you look at the Chinese cases, they really level off very notably here in the month of February. You see it's a flat line. In fact, if you listen to some of those reports in China, they state that, really the only new cases they have are for people that are coming into China. We don't know. Here in light blue, you're seeing the US cases, which are really ramping up. And that's the concern. And the concern is that what's that slope going to look like? So how do I move this over? Oh boy. Well, this is great. We're all learning on the fly. Okay, let's just stay with this chart here. So the active cases that are roughly 30 days from acceleration and lockdown. So this is the best way that we're aware of to give you a sense for how long this is going to last. And again, so some people don't trust the Chinese numbers, which are here. And this is from the WHO and the CDC data mapped out. And so you can see the new cases are dropping precipitously in China. They also are doing so the same in South Korea. Now, many people do not have skepticism of the South Korean numbers. Chinese numbers maybe, but the South Korean numbers, they don't. Yet, at the same time, many people point to South Korea saying, yeah, but they really lock things down. We're not doing the same thing here. So they say, well, geez, are we doing better than Italy? And Italy here is in gray. And our cases were for a little while behind or really matching where Italy was. We're seeing a little bit of a spike here. These next couple of weeks are going to be really important to see exactly what our results look like compared to Italy, because it's starting to look like Italy's cases are topping out. And you're seeing the fact that Italy's cases topping out, and where we're having a horrendous week last week with the stock market, Italy's market did significantly better than ours because the rate of cases has slowed. It still went down, but didn't go down anywhere near as much as the US market. So what this chart is indicative of is that we are a week or two away from really understanding likely what the peak case looks like. And if we continue with this relative lockdown that we are experiencing here in this country, then the expectation is that you'll see a gradual decrease. And that's the kind of thing that the market would look very favorably upon. So what does that mean? Does that mean that we're out of the woods yet? Not obviously not, and not necessarily, but it helps to put this market correction in context, and this likely recession that we're in context as well. So let's start to take a look at this rapid sell-off, and then figure out where it is historically speaking to gain a greater sense for whether or not we're going to see, what we're going to see in the coming weeks and months ahead. This, again, also helps us figure out what we're going to be doing with portfolios. See, now I really got the hang of this. This is good stuff. Okay. So the 10 best and 10 worst one-day percentage moves. So let's look at the graphic information here on the left. And this is the largest one-day gains. You can see we had one of those last week. Market was up 9.3%. What did the market do the next week? Did terrible. So can we gain any understanding by looking at the largest one-day changes and how the market's going to perform the next week? No, not necessarily. In fact, if we do, then it looks like the average is a negative rate of return, not very encouraging. If you go to the right-hand side, what you'll see is that we've had 2 of the 10 worst individual days in stock market history last week. And if you look at that in where we are historically, you can see that when you get these huge, I'm going to use the term that we hope it is, kind of washout numbers, then that could be a sign that things are coming to an end. Let me describe what that means. When things are washing out, it means that you have a number of people that are capitulating, giving up, selling their shares, and there are people that are buying it for a price that they think makes sense. This process of finding new owners and getting rid of original owners is super healthy, because at some point, think about it, at some point, everybody that wants to sell sells, and that people who now own these stocks or different investments in the market now own it at a price that they like. That's the natural cycle of things, and that's what has to happen. So that looks good. That makes some sense. Let's take things a step further here. And not only are we having this problem with the market, we're also having this problem with oil as well. And oil is a particularly big issue. Look at this chart, though. The decimation of oil prices, and that's really what it is, a decimation. It's under $20 a barrel to close out the week. That's half of its average price going back to 1983. Wow. And I thought this was an interesting anecdote, but at some point during the week, there were analysts that thought that the price at this rate could go negative. Understand that if you continue to pump oil and no one wants it, where does it go? Just sits in oil tankers in some cases, and we saw that in 2008. And you see it during certain market cycles when too much oil is being produced. And that's essentially what's happening right now. There's just not enough energy consumption as economies are slowing down. But the degree to which the oil prices have gone down has caused a huge amount of problems for all different oil and energy companies. So much so that many pipeline companies are down 60, 70, 80%. Huge, awful, terrible. If you're looking at big oil and energy conglomerates, those stocks are also down significantly as well, 40s and 50% plus. And it's hard to imagine that those energy companies are going to come back without some type of resurgence in the price of oil. So you guys know that we have used, and many of you who are watching this, we've used W.H. Reeves as an energy specialist when we felt like that was the right place in the market to be. Should we feel like energy makes sense at some point, or we feel like that part of the market's washed out, that would be the kind of manager that we would look to implement in everyone's portfolios, and we buy the mutual fund again. But unfortunately, we're not quite there yet. We don't feel like we're in a place where we know who the winners and losers of the energy market are going to be. So that is not a holding that we're going to be exploring at this time. And if you take a look again at the broader market about these drawdowns, this chart says it all. What this chart shows us is that, and by the way, this is through Friday, so this is automatically old news. The market's down just about 35% from its all-time high. In the market, I'm talking about the S&P 500. That's where we are now. The previous market correction that we experienced was in 2008, down 56%, peak to trough. 49% when the dot-com bubble burst, 48% we had the energy crisis in 1970, and then we had the depression when the market was down 86%. So let's talk for a second about how this differs. The COVID-19 situation is very different, and it is both bleak and concerning on a lot of levels. So it's early in this process, but what we see that looks like it is a form of green shoots, and green shoots, you know, I know it's a little early to say that, is that much in China has gone back online. And you might think, well, yeah, but you know, the Chinese do things a little bit differently than we do, and that may be true. But 90% of Starbucks being open certainly is a cause for some level of excitement. It is the kind of thing that, you know, we look at and say, you know, there seems to be a growing, perhaps definable beginning and end to this process. Now we're getting a sense for roughly how long it is. And we're going to try to figure out, can the market and the economy, really, can the economy sustain itself over these next couple of months? Because this is different than a financial crisis. We don't have a banking crisis at the moment. Banks are really well capitalized. We understand that there's a potential domino effect of people not paying their mortgages because they don't have jobs, businesses not paying their notes on their buildings because they don't have any revenue or income. We understand that there's dominoes there that falls back to the banks and their balance sheets. But we're seeing real direct government intervention to help mitigate what that looks like. And we've also seen financial stocks, which are down more than 40% on balance, already start to reflect these 2008-like circumstances. So it's a good point just to reiterate that the market looks forward. The market is thinking 9 months out. The market's not reacting to something today. They're reacting to the future. They're reacting to things that haven't happened yet. And anything that happens that is positive will hopefully then impact the market positively, that's different than what the market already feels. Because there's a lot of concern and there's a lot of angst and anxiety that's going on with the market right now. And that's being felt in all areas of the market. Let's look at some other areas. Let's break it down. Here are those energy conglomerates, and this again is as of last week. It's down a little bit more now. Energy pipelines down 54%. So if you own MLPs, we certainly didn't put them there. So you certainly want to get out of those, or look to harvest losses and maybe reposition into something else. But look around. Look at the small cap stocks, micro cap stocks down more than 40%. Emerging market stocks down a lot. And there's also a lot of issues with the amount of emerging market debt that suddenly is sitting on their balance sheets, which is concerning. So you look around and there just isn't much that doesn't have this red in there. Municipal bonds down 17.8%. Those are the high yields. And then the regular munis down 7.5%. It's been a really interesting, bizarre, difficult year for most asset classes. And we positioned client portfolios in such a way where we are using municipal bonds as a safe haven tool. And if you look from January 1st all the way through the beginning of March, municipal bonds are working exactly the way that we thought that they would and the way they historically have. As long as there's no risk or fear that there's going to be municipalities that are going bankrupt, we look at it and they look at it and say, well, you know, all systems go. This is in terms of quality, the type of bond that's second only next to, you know, treasuries, for example. And it's the kind of thing, a lot of those bonds that if there's water and there's electricity, then those bonds are going to get paid. And if you're worried about your municipal bonds defaulting, you got a lot of other problems, specifically the fact that, I mean, do you think that your water is going to stop, or do you think your energy is going to stop? And if those kinds of things happen, what does that mean for the economy in general? So point is, we feel great about municipal bonds. We see these discounts are the kind of discounts that we haven't seen since 2010, massive sell-offs, and opportunity for us to be buying bonds with both hands. So it's interesting because we're really trying to do two things at once. Number one is we would love to sell some of our municipal bonds at a fair price and be buying stocks with them. Wouldn't that be perfect? Because that's exactly what we wanted to do. At the same time, we would love to be acquiring more municipal bonds because, my goodness, the valuations are amazing. And we believe that the type of bonds that we'd be buying now, if we bought them now and we held them from now till things started to normalize, we think there's, anywhere between a 5 to 8 to 10% or more natural appreciation in the price of the municipal bond plus the tax-free interest. That's the kind of thing that we're looking for. So many times, many of you will ask me, I have some extra money, is now a good time for me to be investing? And historically, to each and every one of you, I said, no, nothing worth looking at. So municipal bonds, if for nothing else that we could be buying right now, are the kind of things that we feel really good about, really strong, and the kind of things that we're, to use a term, we're buying with both hands. We talked a little bit about the market dropping, but I think you'll like this chart. I mean, like it, and you won't like it, but it's good information. The 30 days it took the market to fall 30% is the fastest ever. So we're trying to figure out whether or not, first of all, how fast. I think the best way to show you is on a graph, and how much longer could this go on? And there's a few different ways I've broken this down. This is one. And if you look here, this part of the chart shows you how quickly this drop happened. And you can see right now, as of today, we're down here. So we are almost equal to the market crash of 1987, which took significantly longer. So here's the thing. You're going to hear and see a lot out there that is going to say, oh, well, this is far from over. And people are programmed to say that because they're looking at other 30% corrections and saying, oh, well, when you get a 30% correction, it takes a long time to unwind. Well, historically, in these cases, it has, unless you mean in 87, where, it didn't take all that long. It took, it was under 100 days to get that total correction done and out of the way. And there were other issues at play at that time. We've never had a correction like this. We've never had an economic situation roll out because of a virus quite like this. So there's nothing that we can really compare it to safely, other than to say that this chart helps us begin to understand, my goodness, how quickly this happened and how quickly things unwound. Again, the question becomes, where's the market going to go next? I would show you this chart. Let me show you this chart. This was pretty good too. So we're taking a look at the market 1 week, 3 months, 6 months, and a year after the market fell. So the market fell 30%. So you got the 1929, 1968, 73. These are all the 30% corrections. I've shown them now on a couple of slides. So maybe you're getting used to seeing them. But if you look, the average 6-month return after the market's fallen 30% is +3. The average market return a year later is 6.9. Now I know when the dot-com bubble burst, it wasn't over yet, but the financial crisis a year later, it was really almost over. But remember, with the financial crisis, it was a little bit different. Let's talk about the difference. It's super important. During the financial crisis, we were getting more and more information. It was kind of being revealed. We didn't know the extent of the problem. We didn't know the extent of the, I'm going to call it contagion within banks and the over leveraging that unwound. And as that new information came out, it was 10% down, and it was up 10 and then 20. And it just took a long enough time for that information to come through. This is all very concentrated. So if we can get and see that there's some kind of government intervention to stem some other massive and major fallout, then the thought is that we will be able to get through this situation faster than we did before. If you remember, during the financial crisis, it really wasn't until the Fed and the government worked together in tandem where we were able to put that bottom in place. It hasn't happened yet as of today, but the House and the Senate have both put forth plans now to put $2 to $2.5 trillion into our economy. And if you look at the $2 to $2.5 trillion in terms of its size, it's 10% of our total economy in size. If you add to that what the Federal Reserve is doing, we'll hit a little bit more on that as well, you're looking at a total impact of greater than likely $4 trillion impact in a short period of time, driven to our economy at one time with a short-term situation that we're facing. So we've never seen a situation like this, but we've never seen a positive potential impact like that either. So we tend to look at that situation as one of, maybe this is something that's going to look and feel and act different because we are getting significant government intervention. And when you're trying to compare this to other market downturns and 30% corrections, this breaks it down again. This is again you got the Depression here, and then you follow by the the early 70s, and all the different 30% corrections and how long it took to fully recover. The red shows you 30%. Sometimes it took a little bit longer, sometimes a little bit shorter. But what you can see is that in some cases you're going to get a little bit more of a downward pull and then a bounce and a downward pull, but you're getting a real good chunk of the downside out in each and every one of these cases. 2007, mind you, it took a long time for the government intervention to come and step in and provide stability to our economy. So that took some time. We're certainly trying to put the stop and the bottom on this thing much, much quicker, which again, hopefully will work in our favor. Because you're looking at parts of our economy like here, these small cap names, look at this. There have been a few different times where the small cap names have been down more than 40% where this red line is. But one was the financial crisis. The other was after, again, the dot-com bubble burst. But really, you almost never see opportunities to buy into this asset class at a rate that's so low. Could it get worse? I'm not here to say it's the absolute bottom. I hope that it is. So as of today, we've started to move and reduce some of our large cap US positions that we have for most of our clients and slowly start to buy the small and mid cap ETF. Buying individual small cap and mid cap companies is something that we could do, but it hasn't necessarily always proven to be more successful than just buying the indexes. And we feel really good about buying into, in small portions, some of these indexes now and start to accumulate a larger position. Obviously, if this was the absolute bottom, then we may not be buying anymore. Wouldn't that be neat? But it's likely going to be the kind of thing that we're going to slowly look to accumulate more of over time. We're going to switch gears and talk about the job market. So the job market, The job market is one that is, certainly it deserves some attention because we don't exactly know how deep this recession is going to go. And by the way, I think that if I haven't said it yet, I don't think I have, that we're in a recession today. The job market is going to give us some shockingly awful information. It's going to have data that is going to be the very worst data that we have in recorded history. So we know all that, the market knows all that. It's pricing it in now, which is why part of the reason why the market's down so much. So let's look at a couple of slides that show us a little bit about what to expect there. Initial jobless claims jumped 70,000. That is new, and that is not great, but that is just, it isn't even really the tip of the iceberg. It's just a very, very extreme top edge. Look at the chart down below on the bottom right. What it shows is the Google search trends for unemployment benefits. And Google searching doesn't necessarily lie. And if you look at where the red dot, which are the national claims implied, um, and what we're getting from 15 different states in the orange square, where we have already seen some claims start to come in, you could take this unemployment data back as far as you want, but it's going to be a massive number when it starts to come through. There's going to be certain economies that are hurt worse than others, but you're looking at millions of people hitting the unemployment market at one time. We've had clients that have laid off significant numbers of people in a very short period of time, and goodness, we're sensitive to that, and we are aware that it's happening. But at the same time, the government is aware that this is happening too, and they're trying to provide a safety net, both in real financial compensation, and they're, again, improved unemployment coverage, and they want to make sure that their businesses are up and running so that when this thing does resolve, that there's a job for people to go back to. So the Fed's done a lot. There's too much for me to go over everything, and the government's trying to do more. We've touched on it a little bit, but let me just share with you some of the things on this list. Look at this. Look at just for monetary policy and fiscal policy. They moved rates to zero, which they're increasing buybacks, but again today, bond buybacks. But again today, the Fed came out and said, we have an unlimited balance sheet, and we're going to do what we can, and we're going to be buying mortgages, we're going to be buying treasuries, we're going to be buying munis as well. So you saw, and corporate bonds. So you saw corporate bonds, that index, it's usually one of the most liquid investments that exists. Corporate bonds were down 16%. Today it was up 7%, just on the news of what the Fed was doing. That's the kind of relief that the Fed has taken. They did it. The Fed did not act alone. They had to get blessings from the Treasury. They did so. And when you look at all of these different things that they're doing, they're going to be doing, they want to be doing direct lending, all of the different measures and support activities is incredibly supportive to our market, and the degree to which that they're doing it in the trillions. You can't underscore the positive impact that has on the markets to provide calm and stability. And you can't underscore the impact that will have on your portfolio, which gives us the confidence to take small steps forward. What would give us greater confidence is that the federal government starts doing the right thing. And so there's a saying that goes a little bit like, when people are panicking, that's the time where, the stock goes down. Stocks tend to do well once the government starts panicking. And once the government starts panicking, they typically will do something to provide some kind of relief. And that's essentially what is hopefully going to happen here over the next day or two. And we expect to see, hopefully would be the best case scenario be a bottoming of the market. And then we would expect to see, we're laser focused on the COVID-19 results. We're laser focused on the implementation of what the government's putting in, making sure businesses stay solvent and have things moving forward. So, and it's one thing for this to be happening just here with our Fed, but look at what's happening across the world. What's happening across the world, Australia, Brazil, Canada, China, EU, you name it. They are all coordinated, acting together. So we're trying to find these kind of green shoots, these small elements that are going to provide us a backdrop that things are moving in the right direction. But look at the way the world is throwing money at the situation, and they're not delaying. Right now, as of when this was taken, and this is what, March 19th? So that's old news. What is that, Thursday? Yeah. So that was 3% of worldwide GDP being put back into the economy. Just at that time. That doesn't include what the Fed's going to be doing today and what hopefully Congress is going to figure out here within the next couple of days for additional bailout. So watch that news, and specifically, you don't just take our word for it, but understand that David Tepper and many of the other of the largest multi-billion-dollar investors in the world, they're all waiting for the same thing. We're all waiting for that green flag to wave. That's one of the things that we're waiting for, to start putting a bottom into this market. Because what you're starting to see as for estimates are scary. Let me show you. There are 291 quarters where the government's reported its GDP, how much the economy is growing since 1950. And 14% of the time we had declines, which isn't all that often. But a decline greater than 5% almost never happens. But we did have one in 2008. But here, I want you, just before we get to the chart on the upper right, let's look at the one on the bottom left. How many times did you see a particular red line quarter where it was greater than 5%? We did have some, but this goes back to 1950, but it's very, very, very rare. Now let's take a look at this chart overhead. Can you believe that Goldman Sachs had the nerve to come out and say that they think that the US economy is going to shrink by 24% in the second quarter? Wow. Bank of America at -12. Listen. If you look at the estimates in aggregate, it's somewhere between -5 to -10. I'm just surprised that Bank of America and Goldman Sachs are coming out to say -24 to -12. Those are massive numbers. I wonder if I say if as if it's going to happen, but if there is some type of a government bailout, if they'll end up changing those figures, and if they end up revolving that information to say that maybe because of this government intervention or what the Fed is doing, that it's maybe -7. That's a long way for Goldman Sachs to reach, but it's likely that they haven't fully embraced what is coming down the road, because as of the time when they made those projections, the Fed hadn't done what they did to the fullest extent, and the government hadn't done anything. So the question is that, well, what do I do? And some of you have seen this chart. I'm going to show you again because it's worth showing you twice. Okay, I could take any 15 or 20 year period of time, and it's going to show you the same thing. If you look, we invested from 1995 to the year 2020, and you would have endured the dot-com bubble bursting. You would have endured the financial crisis. You would have endured that -20% fourth quarter in 2018. You would have also endured a good chunk of this downturn as well. If you had owned just the regular S&P 500 index throughout that whole time without selling it or moving it, your rate of return on an annual basis would be 7.3%. It's pretty good. But if you take out the 30 best days over that 15-year window, because I'm going to get out now and I'll get back in when things look better. And listen, I can't tell you how many times people have been saying that to me. Why can't we just sell now and then we'll get back in when things get better? Because I don't know when those days are. And just missing the best 30 days takes your rate of return from an average annual 7.3 to 0.5%, which is even less than inflation. So you're guaranteed losing money, let alone the fact that you got to pay some tax on that. So after taxes, after inflation, you're net losing money. There's no point for even investing in stocks at all. So I don't know when those 30 best days are. I don't know. It could be tomorrow. So the government could announce a deal tonight or one day this week, and the market's up 1,500 points, 2,000 points. I don't know. You don't know. No one knows. But I do know this. You have to have some element of staying invested if you're going to invest in stocks at all. And I'm not saying you have to invest in stocks. There's plenty of upside opportunity in municipal bonds right now. But if you are looking for long-term growth, and if you are looking for exceptional returns over a long period of time, what the market's doing right now is no different than what it normally does. It goes through cycles of massive expansion, and then there's something that happens that creates this bust. And in this case, it's COVID-19. So what will happen in this process is that there will be some things that don't get bailed out and don't get rescued. Maybe it's Pier 1 imports, and maybe it's the final death blow for Sears and J.C. Penney's. I don't know. I find it very unlikely that those folks will be bailed out, and I find it very unlikely that those folks have the financial wherewithal to continue going with no to low sales. So, and maybe this is the thing that pushes Macy's, which is under $5 a share, to zero. So I'm not saying that this doesn't have its winners and losers, this economic evolution that we're experiencing right at this moment. We're going to try to avoid some of those, and which is exactly why we're not right now invested in energy heavily and focused on energy and oil and things like that. We're trying to be balanced, and we're trying to be poised with this. And we, again, broad strokes is we are slowly finding liquidity where we can. In some cases, for some of our clients, we've been able to sell some municipal bonds at small losses or no losses at all. And we're going to use some of those dollars to redeploy into the market starting tomorrow. Some of the moves we've done today. You may have seen that we've made some of those sales over the past couple of weeks. We've been preparing for this. Again, you're going to see the entrance of more small cap and mid cap indexes. We're going to have, again, continued focus on trying to find the right type of single stock positions that make sense in the economy moving forward. It's important to note that we're not calling an absolute bottom here. It would be great if it was, but we do know that a lot of the downside's been priced in. I don't know if it's another 5 or 10% lower from here. A lot of it depends on the government plan and the implementation of the government plan and what the Fed's going to do and how they're going to implement that as well. But assuming those things go well, this may indeed be the absolute bottom. And for as quickly as we went down, most of those economists that we read that we respect tend to believe that we're going to have this U-shaped recovery. I think they want to say it's straight down, straight up, but no one's that brave, particularly because we don't know how the government plans are going to be implemented. But wouldn't it be magic if the government was able to keep solvent the vast majority of all employers, so that, again, when people could go back to work, had a company to go back to? We certainly hope that's the case. There's lots of stuff that we're looking to buy on individual names. Again, I'm happy to share this chart, this information with you. Some of the things are COVID friendly. Some of these things are dividend aristocrats, and we're really hopeful that again, working closely with you, your families, making sure that your financial plans are up to date and are financially sound, is something that we all want to revisit. So here's what I'm kind of encouraging. If you have additional liquidity, this is the kind of market that we want to be buying into. This is the kind of thing you say, well, I have the extra 100, I'm going to go ahead and let's put some of that cash and capital to work. If we want to go conservative, we'll go municipal bonds. There's certainly plenty of equities, both on the large cap individual side or on the mid and small size with the indexes that we can use. And certainly don't hesitate to ask questions. I know a lot of you aren't, and most of your emails start with, I'm sure things are crazy right now. And they are, but for us, this is what we do, and we love what we do. So with that, certainly go ahead, fire away, ask us any questions that you want. Be sure to follow us at Manage the Funds. And I say that not to be self-serving, but we put out a lot about what we're doing and why we're doing it and what we're seeing and what we're reading. So if you go to anything like your Facebook, your Twitter, your Instagram, whatever you like, and go to Manage the Funds, we've got a lot of content there that we're putting out on a fresh basis. So it helps keep you in touch with us. So that's what I got for you. Take care and have a great day. Well, I certainly hope you enjoyed our latest installation of the Manage the Funds podcast, COVID-19 Market and Economy Special. If you have any questions, certainly don't hesitate to reach out to us anytime. You can always drop questions to us very easily on social media. You can find us at Manage the Funds. That's our handle. There's no spaces. Or you can find us at managethefunds.com. I hope you enjoyed this podcast as much as I did recording it, even with everything that was going on right now. Again, I hope you are all doing safe. You're doing well. You're feeling safe and okay during this real trying time. Take care and have an outstanding day.